Hi, I'm James Allen from Future Accountants and Advisors, the Illawarra's leading SMSF firm. In this edition of Super Savvy, we're going to talk about dividends and franking credits. So what's a dividend? So dividends represent the profits that are paid out to the shareholders by the company. So if you have cash at the bank, you'd receive interest, and if you had an investment property, you'd receive rent. The same as if you hold shares in a company, you receive dividends. That's the income that you receive for holding that investment. But unlike the previous two examples, dividends are a little bit more special. The reason for this is the companies are subject to a 30% company tax in Australia. So that means the dividend that you receive is fully franked or having tax paid at it at that company rate of 30%. So what does that mean? Let's take an example. If you hold these shares in your super fund and your tax rate is up to 15%, you're in the accumulation phase. You hold shares in a company and you receive a $1,000 fully franked dividend. Well, that 30%'s taken off already as the company tax, so your super fund receives $700. Okay, but remember we used that example of being in your super fund, maximum tax was 15%, so essentially you're getting half of that tax paid back to you as a refund. So $150 comes back in your super fund as a franking credit. So that franking credit is that tax refund or rebate paid back to you or your super fund. If you're in the pension phase of your super fund where the tax rate's zero, you're going to be receiving that whole 30% franking credit back into the super fund as well as your dividend. I hope this has cleared up a little bit of information about how dividends and franking credits work in your super fund. This is James Allen. Stay wealthy.